Whole life insurance has one of the most polarized reputations in personal finance. On one side, commissioned salespeople love it. On the other, every financial blogger on the internet hates it. The truth, as usual, is somewhere in between, but much closer to the skeptic's side than the salesperson would like you to believe. Today we're going to give you the honest answer. Yes, whole life is worth it, in exactly 3 situations. And if your situation isn't one of those 3, you're probably overpaying. This is Policywise, insurance explained honestly. Quick recap, because the comparison matters. Term life is simple. You pay a premium, you're covered for a set number of years, and if you die within that term, your beneficiary gets the payout. It's pure insurance, no cash buildup. When the term ends, it ends. Whole life is different in 2 ways. First, it never expires. As long as you keep paying, the policy stays active until death. Second, part of your premium feeds a cash value account that grows slowly over time, tax-deferred. You can eventually borrow against it. The cost of that permanence is significant. The same $500,000 death benefit that might cost a healthy 30-year-old roughly $25 to $30 a month on a 30-year term policy could cost $400 to $500 a month or more as a whole life policy. That's not a small difference. Over 30 years, that's potentially over $150,000 in extra premiums. So the cash value component and the permanence had better be doing some real work for you. Otherwise, you've massively overpaid for your insurance. Let's address the most common sales pitch. Your money grows inside the policy. This is true, but the fine print matters enormously. In the first several years, often the first 5 to 10, the cash value in a whole life policy is very close to 0 after the insurer subtracts its costs, administrative fees, and agent commissions. Those commissions are substantial. On a large whole life policy, the first-year commission paid to the selling agent can equal a significant portion of your first year of premiums. The growth that does happen is typically guaranteed at a modest rate, historically around 2 to 4% on the cash value, depending on the policy and insurer. A low-cost index fund tracking the stock market has historically returned considerably more than that over long periods, though with more volatility. This is the core argument behind buy term and invest the difference, which we'll cover in its own episode. Another common misconception: if you borrow from your cash value, you're borrowing your own money. Technically, no. You're borrowing from the insurer, using your cash value as collateral. The loan accrues interest. If you die with an outstanding loan, the death benefit your family receives is reduced by the outstanding balance. And if the loan grows large enough to exceed the cash value, the policy can lapse, potentially triggering a tax bill. It's not quite the magic piggy bank it's sometimes sold as.
Situation 1. Estate planning, specifically for high net worth individuals in jurisdictions with significant estate or inheritance taxes. If your estate is large enough that heirs would need to sell assets, a family business, real estate, just to pay an estate tax bill, a permanent life insurance policy can provide liquidity precisely when it's needed. The death benefit arrives tax-free and immediately without going through probate. For this use case, permanent insurance is a legitimate planning tool. But this is a strategy for people working with estate planning attorneys, not a reason for a typical family to buy whole life. Situation 2. You have a dependent who will need financial support for their entire life, not just until your kids are through college, but indefinitely. A child with a severe disability, a sibling you've legally committed to supporting. In this case, a 20 or 30-year term policy has a meaningful gap. It might expire while your dependent still needs support. Permanent insurance closes that gap. It's expensive, but in this specific scenario, the permanence is doing real work. Situation 3 is the controversial one. For some people, a whole life policy functions as forced, structured long-term savings. The premium is non-negotiable, the money goes in every month whether they feel like it or not, and it grows slowly over decades. For a person with a documented history of spending every dollar they earn, unable to maintain investment accounts without rating them, the forced savings discipline of a whole life policy has genuine value, even if the returns are lower than alternatives. It's not optimal, but optimal that never happens is worth less than second best that actually does. So where does this leave us? If you don't fall into those three situations, high net worth estate planning, a lifelong dependent, or proven inability to invest otherwise, the math almost always favors term life plus independent investing. You get the same death benefit protection at a fraction of the cost, and your investments grow in your own account at rates you control. The people who end up in expensive whole life policies they don't need often got there because of a great sales conversation, not a careful financial analysis. Now you have the framework to tell the difference. Who should pay closest attention to this episode? If you're in your 20s or 30s with dependents, the default recommendation for almost everyone in this life stage is term life. Don't let anyone sell you whole life without explaining exactly which of those three situations applies to you. If you're a business owner or have a complex estate, situation 1 might actually apply. Talk to an estate planning attorney, not just a life insurance agent. If you're a parent of a child with special needs or a lifelong dependent, situation 2 is real and important. A special needs trust paired with a permanent policy deserves serious conversation with a specialist. If you're self-employed and struggle to maintain consistent investments, be honest with yourself about situation 3 before dismissing it.
To recap, whole life insurance is worth it in 3 situations: estate planning for large taxable estates, providing for a lifelong financial dependent, and as forced savings for someone who genuinely won't invest otherwise. For everyone else, term life at a fraction of the cost, combined with separate investing, is almost always the smarter financial move. Next episode, you might be thinking, I've got life insurance through work, I'm covered. Most people think this, and most people are wrong. The hidden gap in employer-provided life insurance can leave your family critically short. That's coming up next. Subscribe for one honest insurance breakdown every week. This is Policywise. General education only, not financial advice. Talk to a licensed professional before you buy.